Good evening, everybody. Luke Gromen, FFTT. Hope everybody is doing well and has had a great weekend. As some of you that follow me on Twitter probably saw, I was out at a Field of Dreams like baseball field out in lovely Vickery, Ohio, which is a farming community about an hour west of where I sit now. Great time. Guys did well on the field. It was just good to get out and watch some baseball. So with that, we are going to jump right into the topics tonight. So the first question comes from OC. Thoughts on China's strategic gold mine buying? And highlighted that the Chinese announced yet another buy of I believe it was a Canadian gold mine. For me, it's as simple as watch what they do, not what they say. It's a pretty big non sequitur that again, and we've seen non sequitur these non sequiturs over and over for a country that is reportedly acutely short dollars and centrally planned. That they're finding the dollars somewhere to buy these gold mines. And to me, it really speaks to this ongoing theme we've seen really since 2008 at an accelerating pace, which is China is saying, you keep the dollars, we'll keep the gold, copper, rare earths, oil, fill in the blank, finite commodity. So I think it's just another signpost on that path in my view. Next question comes from MH. What is Fed recourse if stocks fall and do not react to another monetary policy injection? Is it simply game over, or can they maintain control without stocks rising faster than TLT, faster than the long bond ETF? I think the answer is more cowbell. To paraphrase the Saturday Night Live skit with Will Ferrell that I think was used by maybe it was David Einhorn a few years back. Look, our views with stocks at 155% of GDP, with net capital gains and taxable IRA distributions at around 200% of annual personal consumption expenditure growth, and with PCE at 2/3 of GDP, U.S. GDP cannot mathematically rise unless stocks are rising. And we've seen that a number of times. Last week, Powell all but confirmed that in his press conference in what I thought was a big moment. The punchline is that if GDP can't rise mathematically unless stocks are rising, if GDP doesn't rise, when you've got debt to GDP at 120% of GDP, growing rapidly, and really 500 to 1,000% of GDP when you add in entitlements, if you have shrinking GDP with those type of debt numbers, you have a death spiral, a fiscal death spiral you start to enter pretty quickly. And once you enter it, it's really hard to get out of. And so our view has been and remains that I think we'll see a lot more of what the Fed has done over time, but not that far in the future, where they will apply things slowly, but ultimately when they need to apply shock and awe, they'll apply shock and awe. Whatever it takes, basically. FC, what do I buy to replace long-term treasuries in my portfolio? Every situation's different, and we'd advise talking to your financial advisor what's right for you. For me, I can speak to, which is all else equal, given my secular view, our research that points to this view that we are entering a golden age of fiat currency debasement globally, pun intended, I would much rather own a 0% yielding bond of infinite duration and finite issuance, which is what physical gold is, than own a low yielding bond of finite duration and infinite issuance, which is what treasuries and other sovereign debts are. And the punchline here is that it seems highly unlikely that the U.S. government and really Western sovereigns broadly are going to be able to pay positive real rates of interest on their sovereign debt on a sustained basis anytime soon until their currencies are significantly devalued. And if that's the case, then they have to keep real rates negative for a period of time, and that's a perfect environment where I would rather own gold than sovereign debt, at least in some amount. WD, Luke, where do you think Russia's interests lie in terms of great power struggle between the USA and China? It isn't clear to me that BRICS is a given. In my opinion, Russia sees U.S. and in particular the U.S. dollar-centric system as the more clear and present threat to Russia than China. And I say that based on numerous Putin pronouncements, easy for me to say, over the last 10 years. And in my opinion, the number one threat to them is that if oil is only priced in dollars, and Russia primarily stores their wealth in treasuries and in U.S. financial assets more broadly, but treasuries in particular, then as the U.S. is forced to print $100 to $200 trillion perhaps to pay for baby boomer entitlements over the next 10, 20, 30 years, Russia will essentially have sold their finite oil supplies for paper that is inflated away. And Russia's oil will be depleted, and they will have a pile of paper that will have depreciated against the new price of oil, and Russia will basically have to buy back their energy imports at a much higher price. And so for me, Russia, based on what Putin has said, based on this calculus, I think the much more clear and present threat is this dollar-centric system and how it threatens Russia's national wealth over the next 5 to 10 years. Now, I think ultimately, when you talk to people, the China-Russia relationship is a matter of convenience on some level, and there are some historical tensions there that I don't want to downplay, but I just think in terms of order, I think they see this dollar system as the bigger threat in the near term. From AL, what assumptions of ours may be upended in coming months and years with respect to gold and Bitcoin? What might we be missing that actually leads those to drastically underperform? So it's a great question, and it's something I always like to do when I feel strongly about something. I'm always wanting to check the other side, so I appreciate the question. For me, there's a happy outcome and a frightening outcome in terms of where we could be wrong on a nominal basis in terms of the price performance of gold and Bitcoin. The happy outcome is that the U.S. or the world comes up with some new revolutionary productivity enhancing and massively productivity enhancing economic tool. So, for example, if it came out next week that the United States or somebody else has some sort of cold fusion that's ready to be commercialized and that energy costs will basically fall to zero forever, and we'll be able to replace cars, buses, the entire, then you would have to, I wouldn't want to own gold, I wouldn't want to own Bitcoin probably, either one of them, because ultimately the productivity enhancement that we would see from that would make the debt much more payable. Geopolitically, the nation that had that kind of fusion would have much more power. If it was the U.S., you'd want to own U.S. sovereign debt, etc. So that's the happy thing. And I say it's happy because that is a situation where the quality of life for everyone in the world, and particularly those of us in the United States, would probably get a lot better really fast. The unhappy outcome where gold and Bitcoin do poorly nominally is one where authorities either decide or lose control, but basically the system collapses in a deflationary death spiral in a chaotic manner. And in that scenario, dollar cash probably wins over everything. In other words, gold and Bitcoin probably fall in price in dollars. Ultimately, however, gold and Bitcoin win because if authorities just stand aside and let that thing collapse to the earth, we're talking about almost every piece of corporate debt defaulting. We're talking about pretty much every sovereign debt in the world defaulting, including United States treasuries. The challenge in this really ugly scenario is basically at the end of it, gold and Bitcoin, while having fallen in price, outperform everything else, including dollars. The challenge in that world, the gold and Bitcoin are helpful, but you're going to want rations, ammunition, and a good relationship with your community where people know who you are and you have a strong relationship in a tight community because you're basically going back to the dark ages in terms of localized communities. So at any rate, those are the two scenarios where I see that playing out. And then the last question for tonight, DS, why do you think we will see inflation further down the track if QE is merely increasing bank reserves and is not being loaned out to the real economy? I think it's a great and a very important question. I know there's some different thoughts on that. And for me, the reason I think that is because these bank reserves are in the process of being loaned out. And I think this is an important point to highlight, which is they're being loaned out to the U.S. government. So you can see already that U.S. bank holdings of Treasury bonds are at 20-year highs, but as a percentage of total assets, they're very low. So, for example, in World War II, U.S. Treasuries as a total percent of, as a percent of total bank assets, got as high as 50%. So 50% of the total U.S. banking system's assets were U.S. Treasuries during World War II. That percentage is currently 5%. And I think that 5% is going to move toward 50% in coming years due to what we're watching geopolitically, fiscally, etc., and the lack of sufficient foreign buying. So basically, if the U.S. Treasury issues treasuries and the Fed supplies the cash to the banking system and the banks then buy treasuries, that money is being loaned into the system because, as we know, the U.S. government has absolutely no problem spending money. None. And so if the U.S. government's going to spend the money and then they need to borrow the money and they borrow the money from the banks, that money is being loaned and it is being spent. And so that, to me, I think is important. And then when you further layer on continued supply chains from COVID in the near term, this intensifying trade tensions with China, with talk of reshoring, it strains credulity to me to think that the U.S. couldn't move its supply chains without that being inflationary. The reason we went to China was for the lower costs, the increased efficiency. There are disefficiencies from moving away from globalization. As that happens, I think that is inflationary. If that's happening at a time where the U.S. government is spending money in a very MMT or World War II-like manner, basically wartime finance, then I think that's inflationary. I think that'll be inflationary like it was during World War II. Ultimately, that's a currency depreciation-induced inflationary type trend that could take hold. I don't think it's a threat in the very near term, but I think the incipient pressures are building. And again, I think the key there is really this wartime finance model where U.S. banks are financing the U.S. government and the Fed's given the banks the money to finance it. And the Fed having taken off leverage regulations off the U.S. banks as it relates to treasuries only also helps make it easier for the U.S. banks to lend plenty of money to the U.S. government. So that's going to do it for tonight. I appreciate everybody joining me. As always, if you like these updates, check out FFTT Tree Rings at FFTT-LLC.com, where you can find out more information about that. It's a weekly piece we put out, 10 most interesting things, a number of different synopses. We've get lots of good feedback on it. I retweet some of them and appreciate all that feedback. Appreciate everyone checking in tonight. Otherwise, everybody out there, stay healthy, stay safe, and we will talk to you soon. Take care, everybody.